Hi everyone. I want to start by talking a little bit about recognition. The concept of recognition, of course, surrounds the definition of what an asset, liability, equity, revenues, and expenses are as given in your reading. But we wanted to mention a couple of things, especially with regard to revenues and expenses as to when they are recognized. We're going to look in some detail later about the concept of revenue recognition, but the basic idea is that we recognize revenue when it is realizable and earned, meaning something has been done to earn it, and we have a reasonable expectation that we can receive something in return. So a sale to a company that is bankrupt is not what we would consider to be realizable, and so we need to consider both of those issues when looking at revenue and recognizing it on the income statement. That's probably one of the most problematic issues in accounting, and one of the reasons why the FASB has revisited that standard, and that we'll spend a whole section on that new standard later on this semester. On the expense side, which while probably equally as important, doesn't get as much attention, there are basically four ways that we could look at expenses being recognized or showing up on the income statement. First of all, we could have it such that we're trying to match it with revenue. So while the matching principle is not part of our general principles, the idea that we want to measure how those expenses relate to revenues in the same time period is still very much a part of what we want to do. And so an example of that is cost of goods sold. The cost of the items that are sold is matched against the revenue that received because we sold them. Another reason we have expenses because we have used up the benefit. A future benefit has become a past benefit, or is just that benefit has been used in the past. Salaries or insurance, prepaid insurance gets used up. We consume the benefit over time. Like the people that are working for us, wages, we consume their work in our business. The third one is systematic or rational allocation, such as depreciation or amortization. This is an idea of taking a cost and spreading it over the life of that asset or of that cost. There is very little in U.S. GAAP about depreciation calculations, except that it needs to be systematic and rational in our allocation. And then one that will give us more trouble than probably the rest, because it's probably the most unfamiliar, is when a future benefit is reduced or eliminated. For instance, a building or a trademark or some other asset becomes worth considerably less than what we have recorded it for. We must record that reduction. That becomes either a loss or an expense as we reduce the asset and increase the loss or expense. So those are the times where we recognize our expenses. Going to our next slide, we'll talk about measurement. And notice these are the four elements at the bottom of our last the PowerPoint slide, which had the framework. Measurement is usually thought, again, is the amount of money or that is measured on the balance sheet or income statement. Typically, we measure elements of the financial statements at one of five kind of ways of measuring. One is historic cost. That's been very important, especially for tangible assets such as buildings and equipment. That's what we originally paid for. That's usually modified by some form of depreciation, but not always. Current cost is what it would cost us to replace that item at the current cost right now if we went out and bought it. Current market value is what we could sell it for, Now, most of the time we think that current cost, what we could buy it for and what we could sell it for, would be the same, and I would say 9 times out of 10 it is, but there is a distinction in the accounting rules as to the difference. We have found that current cost is becoming, the rules have basically continue to move away from that as a measurement, so that has become a lot less important, and we have kind of gone to either historic cost or current market value for the most part. Net realizable value is what we'll actually receive if we collect whatever it is, minus any selling costs or any other modifications. So net realizable value applies to, say, accounts receivable. We have our total accounts receivable less the allowance for bad debts equals our net realizable value, the amount we actually think we're going to receive. Inventory might be recorded at its cost minus some amount that for shrinkage based, so we can get to our net realizable value, what we actually have left to sell and get the money for. And then the last one that we will probably give us the most trouble going forward, because it involves a little more math than we're used to sometimes, and that is present value of future cash flows. The concept that money received in the future is not worth the same as money received now based on interest. That application of present value to the cash flows is important in the value of loans, and both receivable and payable, as well as other assets and liabilities. So that's become more important, and we do more present value than ever before in accounting. And so we will have a discussion in a couple of weeks about all the ins and outs of present value and how to calculate that using the formulas and using Excel.